Hi everyone, it's Thomas from Curvo. So the BEL is the main benchmark for the Belgian stock market. It tracks the performance of the 20 largest public companies in the country. It makes it a popular choice for Belgian investors. But how do you actually invest in it? And should you? In this video, I'm going to show you why the BEL seems like an attractive investment. But then I'm actually going to go on to explain why there are actually better options for Belgian investors. In the video, we're going to cover alternative indexes and ETFs that are more diversified. And we're going to focus on Curvo as an interesting proposition for you if you don't want to manage your own investments. So let's dig into the video. So the BEL index was actually launched in 1991 to track the performance of the top 20 companies operating in Belgium. All the companies on the list have to follow a strict criteria, including having a significant free-floating market capitalization. In non-finance speak, this means that enough shares in the company must be tradable instead of being locked up by its founders or directors. So companies in the BEL don't actually have to be Belgian, but they have to be active in the country. A lot of the famous companies that are part of the index include the biggest Belgian bank, KBC, Proximus, Solvay, AB InBev, but the BEL has actually returned an average 6.9% per year since 1994. In other words, a €10,000 investment in 1994 would have resulted in about 57,000 today. That's not bad, really, but it's not great either when you compare it to other similar countries or indexes. So the MSCI World Index, that's composed of stocks from developed markets, I'm talking about Europe, US, Australia, Japan, that's returned an average 8% a year during the same period. So the BEL is an index, and you can't actually directly invest in an index. Instead, what you need to do is invest in a fund that actually tracks the BEL as well as possible. The fund buys shares of each company in the BEL 20 or BEL and then makes sure that it sells or buys the right shares when the index changes. For instance, when they remove a company from the said index. The easiest type of fund for Belgians to buy are ETFs. That's also known as exchange traded funds. You must buy ETFs through a stock exchange, and you need an account with a broker to trade on a stock exchange. There's only one ETF in Europe that tracks the BEL index. That's the Lixor BEL 20. It is identified by the following ISIN code. The fund is actually offered by Lixor, which is a large French fund provider. But you need an account, like I mentioned, to buy the ETF with a broker, including the BEL 20 ETF. There's so many brokers to choose from in Belgium. Each have their pros and their cons. I've done a video that looks at them. And an important criteria to choose a broker is often the price. So each broker charges a fee for each transaction that you make when you buy or you sell. We actually built a tool that allows you to quickly see all of the different brokers and how much they charge. So I've linked that below in the show notes. So make sure you take a look at that for yourself. But before we cover the steps to actually buy the ETF through the broker, we actually wanted to highlight in this video some of the downsides of investing in the BEL 20 ETF. So it's a distributing fund. That's the main issue. They're accumulating and distributing funds depending on how they treat Belgian dividends. Belgium has a 30% tax on dividends. That's why, from a tax perspective, we actually prefer accumulating funds for Belgian investors. Indeed, accumulating funds, they reinvest the dividends so you don't need to pay any tax on them. And accumulating funds are even more attractive because Belgian investors don't need to pay any capital gain taxes on stocks. It's crazy. It's one of the only countries. Unfortunately, BEL 20 ETF is expensive because each fund provider charges a fee to manage the fund. It's called the total expense ratio, or the TER. It's always a percentage of your investment that you need to pay every single year. The TER of the Lixor ETF is 0.50%. That's 0.50. It's crazy because a lot of other TERs are roughly a half or even 0.2%. And because it's the only one available for BEL as an ETF, there's not much we can do about that because it's the only one to buy. Another downside is that the BEL 20 is an easy way to invest in the Belgian economy as a whole, but it's unlikely to become a core component of a solid asset allocation portfolio that will bring you success over the long term. Because when you're investing in the BEL 20, you're just investing in one single country. and you're exposing yourself to potentially bad things that may impact Belgium. So it actually poses a large risk for your long-term savings. Diversifying across different countries and even continents is actually the key to reduce that risk. Also, like I mentioned, there's no real tax-efficient BEL 20, BEL 20 ETF. The only one that does it is a distributing fund. So if you're ready to pay the 30% tax on all dividends, that's a lot of money, and that's going to have a significant negative impact on your returns over the years. An accumulating fund is therefore the best way to not have the dividend tax, but there's no accumulating BEL 20 funds yet, as of this video being recorded. Belgium also only represents 0.24% of the world economy. So investors, they tend to invest in what they know. It's normal. You feel familiar. You feel like you have an edge because you understand the local, complicated Belgian dynamics. But many Belgians invest in the BEL 20, the Dutch invest in the AEX index, the Americans love the S&P 500, the French love the CAC 40, but you're not going to hear many Americans investing in the BEL 20 because it's a tendency that we call the home bias. It usually leads to suboptimal actual investment returns. Really also because if you're only investing in the BEL 20, you're excluding 99.76% of the investable global market. There are so many great companies outside of Belgium that you can invest in. And we saw earlier, looking at different indexes, that the MSCI World has actually a better return. So by focusing just on Belgium, you leave out the chance for actual more money and a higher return on your investments. Furthermore, the BEL 20 excludes many sectors. For instance, technology is hardly represented because Belgium, unfortunately, isn't particularly competitive in that market. On the other hand, you're likely to be over-invested in real estate. What a surprise. And also another downside is that you're investing in just 20 companies. It's not sufficient diversification, and each company makes up too much of your actual investment situation. So it's a risky situation because you're severely impacted when something bad may happen to one of those 20 companies. So again, I'm repeating myself, in order to reduce the risk, it's good to diversify. There is, though, a better way to invest your money, and that's through Curvo Growth. The Curvo Growth portfolio, it's a great alternative to the BEL 20. It's composed of two broadly diversified funds, which are both offered by Vanguard. The FTSE Developed All Cap Choice Index, there's the ISIN, and the FTSE Emerging All Cap Choice, there's the ISIN hopefully displaying for you. And what the Curvo Growth portfolio does is that it addresses all the shortcomings of the BEL 20. It invests in over 7,500 companies from 40 different countries, from both developed and emerging countries. And that's across all sectors. So it actually includes the top Belgian companies. So you do get a very, very small exposure to them. And we also, like I presented earlier, we saw that a global investment earns a better return. It's less risky than concentrating on one single country, such as the BEL 20. So the performance of Curvo Growth portfolio illustrates that, as you can see here on the graph, which is sourced from Backtest. And so we built Curvo's app from Belgium to solve all these complexities to good investing. So you don't have to worry about it. Investing with Curvo can help you set yourself up for long-term success. You get a portfolio of funds which are built for you. After you've downloaded the Curvo app, you sign up with It's Me. We ask you a few questions to learn about what your goals are and your tolerance for risk. Based on those answers, you're actually going to be assigned a diversified portfolio of index funds. So there's no need to pick specific ETFs or figure them out. It's all done for you. You get diversification. We're big proponents of the power of diversification to lower the risk, but also seek better investment returns. And as I mentioned, each portfolio has over 7,500 different companies. Through Curvo, you also invest sustainably. So we focus on one guiding principle. We do not invest in companies that we consider destructive to the planet. What this essentially means is that sectors like non-renewable energy, vice products, weapons, controversial companies, all of those are excluded. And Curvo benefits from monthly automated investments. What does that mean? It means that you can set up a savings plan through the app and you just make money work for you whilst you sit back and relax. There's also fractional shares. This is very unique. All your money is invested. There's no cash left sitting on the side. And you can also start investing from 50 euros. So there's no need for a large lump sum to get started. And security is core to what we do. And that's why we work with It's Me to keep your data secure. And one last thing is also the rebalancing of your portfolio is done for you. Curvo handles all of that. And it allows you to just really focus on projecting yourself into the future, because you can actually, through the app, see how much your portfolio is expected to be worth in the future based on your current savings plan. Another benefit I think I want to highlight is that there's no Belgian transaction tax. So there's no TOB or Beurs tax or taxe boursière. So you're essentially saving between 0.12 and 1.32% every time you buy or sell. You can withdraw money at any time. There's no long-term contract with Curvo. There's no exit fees if you wish to stop using Curvo. And of course, we're overseen by the financial regulators. So your investments are secure. They're regulated by the Dutch regulator, which is the AFM, and the Belgian FSMA regulator. So to conclude the video and to summarize, the BEL 20 has performed actually relatively well in the last 3 decades. However, it does have some limitations for those of you who are investing for the long term. The concentration on 20 companies in one single country increases the likelihood of a bad outcome. Also, the only ETF that's available to us as Belgians is tax inefficient. And so I showed you really an alternative to investing in the BEL 20. There was the MSCI World Index, and there was also investing through Curvo, which both are diversified across countries and sectors. In our eyes, they're a massive improvement than the BEL 20 for investors. One last thing as well is that ETFs still require you to manage your own investments through a broker. That can be an intimidating, challenging, potentially time-consuming process. And that's really why we built Curvo, to address all those complexities and simplify good investing for young Belgians. So with Curvo, you're investing in the right portfolio built for you and your goals. And it's really easy to adopt very solid, good saving habits by automating your monthly investments. So take a look at how Curvo works. Hit that like button if you like this. Comment if you're investing in the BEL 20. And looking forward to hearing your feedback.